Welcome everyone to Vested Interest. This is Shane, and before we get into the video, I'd like to take a moment to thank everyone who's taken the time to watch, comment, and like the videos, and a special thank you to those who subscribe to the channel. And for those of you who may be stopping by for the first time, if you are a dividend growth investor and you have not subscribed to the channel, hit that subscribe button down below. Hit that notification bell so you're notified whenever we put out any new content on this channel. I do portfolio updates every Sunday to go over exactly what I bought for the week or sold, any options plays that I've been running for the week. I'll discuss all that every Sunday morning in the 7:30 a.m. updates typically. We did add $2,068 in new capital to the portfolio. Also, I do a stock pick of the day series Monday through Thursday where I look at a company that has pulled back on the day to see if it's presenting any value. And with the market the way it is lately, a lot of companies are presenting value right now. A lot of red in the market, a lot of very good companies that are down, 5, 10, 15, 20, 25%. So great time to be picking up stocks, great time to be a dividend growth investor. And again, if you have not done so, hit that subscribe button down below and join us on this journey to financial freedom. Join the Vested Interest community, building a community of like-minded dividend growth investors so we can share our experiences, stocks we are watching, stocks we're avoiding. I, again, share a portfolio update like this every Sunday. So let's get into here and see what we added with this $2,068 in new capital. So we'll jump off and start with options. Typically, I am in options right now. I have not been able to get anyone to bite on one at one. The companies that I'm trying to run options are covered calls, so I own the positions, and a lot of the positions continue to drop. So whenever you're trying to do covered calls, people don't want to jump in if you're not selling them for cheaper than what you want to. So not had a great deal of luck the last couple of weeks, but that's the way it goes sometimes. So we'll continue to throw out lines and see what bites we can get on the options plays. We did get some dividends this week on October 4th. HP Inc., ticker HPQ, out of the information technology sector, did pay us $42.65. And with those funds, we have the DRIP set. That stands for Dividend Reinvestment Plan. So any company that pays out on the portfolio automatically goes right back in and buys more shares of that company. So we picked up 1.63548 more shares of HPQ with that $42.65. And that 1.63548 shares that we picked up added an additional $1.71 in passive income over the next calendar year. And on October, it says the 7th, but actually on October 5th, we made all of our purchases on one day, which typically we spread them out a bit. But again, with the UAW strike on, I am working a lot of extra hours right now, which is nice because it does give me a bit more money to put into the market. That's part of the reason I increased my investment this week up to $2,000, a little over $2,000. Usually it's around $1,300 to $1,400. But again, I'm working some overtime right now. So it's a double-edged sword. It gives me some more money to invest, and it's a nice time to be investing more money with the market pulled back. But it does not give me a lot of time to run options plays and really pay attention to the market and invest strategically throughout the week whenever I see companies maybe presenting a little more value than others. But with this $2,068.54, we did add three more shares to our medical properties trust position, ticker MPW. This is a REIT out of the real estate sector. Picked up those shares for $5.23. This is one that's really fell off a cliff here. A lot of REITs have, just because interest rates are so high, but this one even cut its dividend recently, and it continues to fall. So I'm going to continue to add to it, decrease my cost basis, increase my dividend yield, and my potential future returns. I just feel this company is really undervalued, and a lot of the issues surrounding this company are more than priced in at this point, and it's even getting a little ridiculous. I think this even hit down in the $4 range at some point this week. But we got those shares for $5.23. We picked up 5 more shares of Vale, ticker VALE. This is a mining company out of the material sector. We picked up those shares for $12.74 per share. And I really love when this dips under $13 per share, and I will continue to add to this position. This is a Brazilian company, so it is a foreign company. They've got a lot of mines spread out around the world. Really like this, again, under $13. So I don't mind it pulled back right now. I think in the future this one's really going to run up and provide a lot of returns here. Ticker O, the monthly paying REIT, Realty Income. This is a REIT out of the real estate sector. Picked up 4 shares here under $50. I've been picking this up under 60. So to see it drop under $50, I mean, this again is another one that's just, it's too cheap to ignore. So I'm going to continue 2 to 4 shares probably every week here for the foreseeable future. And I like this anytime it's under $60 per share. So I love it under 49 or under 50. NextEra Energy, another one that has fallen off a cliff. I started investing in this position here about a month and a half ago. I should have waited, I guess, about a month, and I could have got it a lot cheaper. My cost basis is a lot higher than now. So I added 4 more shares to my NextEra Energy position, ticker NEE, out of the utility sector at $48.42. And this is one of the ones that I've been trying to run options on, but like I said, it just continues to drop, so no one is really biting on these options. And I don't blame them. I mean, I'm running options at them higher than I even tried to get one in at like I think it's $55, and no one even bid on that. So hard to get anyone to buy any options on this one right now. All right, Cisco Corp, new position here in the portfolio. I've been watching this one for a while. Feel like it's providing or presenting some value right now. Ticker SSY. This is out of the consumer staple sector. Picked up 10 shares there at $64.20. I will continue to build out this position here over the coming months until I get it to 100 shares. Then I'll probably back off a little bit. HPQ, ticker HPQ, HP Inc. here, the one we saw paid out dividends. We also added 8 shares to that position at $26.04 per share. Union, and I am probably going to hold off on adding any more here. I might nibble a little bit because it is under my cost basis, but a lot of other positions are. I've got this to 200 shares. That's really kind of where I wanted it. Again, I might nibble a couple shares here and there over time, especially if it drops down in, like let's say the $24, $23 range. I might add a little bit more there just to bring down my cost basis. But another very long-term play here. Union Pacific, I've been adding 1 share here to this over the last several weeks. Ticker UMP. This is a railroad out of the utility sector. We picked up that 1 share under $200, $199.85. I like this under $211. I would love it to continue to pull back there. It is just above my cost basis, but I'm willing to buy this all the way up to $211. So anything under $200 is a steal on this one, in my opinion. And Haverty Furniture, ticker HVT. This is out of the consumer discretionary sector. Added 10 more shares there. I'm building out this position, very similar to Cisco. This one is a relatively new one. Picked up those shares at $27.35. I want to build this one out to maybe 100, 150 shares, and then probably back off it as well. Nutrien, ticker NTR. This is a Canadian company, so there are some tax implications around it being a foreign company. So talk to your tax advisor if you are interested in foreign companies. Understand the liability there. A lot of brokerages will take out the taxes for you, but some of them do not, so you'll be liable, and you want to understand what those implications are. So NTR dipped under my cost basis just ever so slightly, so we picked up 2 more shares at $58.14. This is one out of the I believe this is also out of the material sector. Yes, this is out of the material sector as well. And 1 share of Johnson & Johnson, another one that I am trying to get to 100 shares. I am oh so close, and I hope that it stays down here under 160 is where I like Johnson & Johnson. Ticker J&J, out of the healthcare sector. You probably are well aware of Johnson & Johnson. It's a behemoth. It's been around forever. All total, we added $72.02 with these new positions in the $2,068. I know that's not a huge amount for the amount that I have invested. A lot of times I'll invest less. I've been investing around $1,300, $1,400 and get about $80 to $90 in passive income. All total this week we got $73.73. But a lot of these positions, besides Realty Income and Haverty Furniture, are under 4% dividend yield, right around 2.5 to 3.5 dividend yield. So some lower medical property trust is another high yielder, but such a small investment there, $15.69. It doesn't make much of an impact. But that's all right. I want to build out some of these lower yielding, faster growing dividend companies as well, not just the high yielding ones for passive income. So we did invest $2,068 and some change, 54 cents. And with the $72.02 we added in passive income from the new investments, as well as the HPQ dividends paid out, $73.73 in passive income added, and I will take every penny I can get. So this is the sector weights. Let's run through them real quick. Communications sector makes up 8.88% of the portfolio as well. right now. Consumer discretionary is sitting at 0.4%. This is that Haverty position as well as Williams and Sonoma, but Williams and Sonoma has really run up. So I'm going to focus on the Haverty position for right now. There are a couple others in the consumer discretionary sector I would like to add. Best Buy is one I've been watching. Might look for a little more pullback there. Tractor Supply, several others. I'll probably pull the trigger on another in the consumer discretionary sector here, as that sector looks to be pulling back right now, and I like to wait for the right time to buy. So we'll see what else we add there over the coming months, but something is going to break. Pool is another one that I'd like to add to the portfolio. So there's a few in the consumer discretionary sector that I would like to add and build out this position. Consumer staples sitting at 5.86% of the portfolio. Energies makes up 6.83%. Financials is sitting at 9.78% of the portfolio. Healthcare, largest piece of the pie, 18.81%. Industrials makes up 8.48%. There's a couple industrial companies that I'm watching. General Dynamics, Lockheed Martin are a couple. Texas Instrument is another one. Technologies making up 8.76% of the portfolio currently. Materials sitting in the second place, largest piece of the pie at 14.29% of the portfolio. Utilities sitting at 5.08%. REITs in real estate making up 12.83%, sitting in third place there. And no ETFs still. Now, I am not against ETFs. I do have some ETFs in my my daughter's custodial accounts. As a matter of fact, I added to both positions ETFs in their custodial accounts, SCHD, as well as VWO, which is an emerging market ETF. I added to both of those. Those have really pulled back as well. A lot of value in the market right now, folks. If you are a dividend investor or an investor in general, there are a lot of companies out there right now that are presenting a lot of value. So don't be scared when you see the red. These are the times you want to buy. It's like going into a store that you are going to buy stuff anyway, and they come out with a big sale while you're there. You don't run out of the store and say, oh my gosh, it's a sale. Everything's cheaper. There must be something wrong with it. No, you take advantage of the sale and you buy more at cheaper prices. That's the idea behind investing as well. Investing in the stock market seems to be the only place where people run for the exits whenever they see companies go on sale, which is not what you should do. That's the time you want to invest more. And that's the time. These times right now really are where millionaires are made. It may not feel that way because your portfolio is in the red. My portfolio is in the red as well. But you keep on investing and things will turn around. The economy will come back. The stock market will grow again. And then that's whenever you make the biggest gains. Now here's my portfolio update for those of you who come by this channel to see this every week. Again, I show this every Sunday. I want to be fully transparent out there so you can see what it really looks like to grow a portfolio. Hopefully this is encouragement for those of you who have not started investing yet. Even though seeing the red might not be very encouraging for some of you, it is part of the process. You are not going to have a green market all the times. You are going to have ups and downs in the market. I think there's a famous quote by Buffett. I can't remember if it was Buffett or Charlie Munger, his partner there, that said, if you can't handle buying a stock and then it going down by 50% in value, you shouldn't be investing. But that is the time to buy. Let's say I buy a good company. I've done the research. I'm in a great company, and then all of a sudden the price gets cut in half. Do I sell it at a loss? No, I hold it and I buy more. I decrease my cost basis. If I did my due diligence, I estimated the fair value of the company, and I have a price that I'm willing to pay, and it gets cheaper. And so long as nothing has changed with the company, you should increase your position. That's whenever you buy more and decrease. And there's a lot of red in my portfolio, but there's a lot of red in the market, and I am okay with that. What am I doing? I'm continuing to buy. I'm not freaking out. I'm not selling out of positions. I'm just steady every week investing into the positions within the portfolio, and even adding right now to some positions that I wanted to add and was waiting on a pullback. SYY was one of them. Cisco there. Where was it? HVT is a recent addition as well, right? Only 12 shares. And I'm all right with that. I'm going to build out these positions. And even that, HVT I just added. Guess what? It's down. Oh no, it's in the red already. What do I do? Well, I'm going to keep on adding. Same thing. Cisco, is it down? Yep. SYY, it's down. Well, that's good. I'm going to continue to add to that position, and I'm going to get it even cheaper as I build out the position. And I'm all right with that. But let's run through here. Here's a ticker. These are all the positions within the portfolio. Total shares I have of each. Current price as of the close of business on Friday. Market value as of the close of business on Friday. My average share cost here. Purchase price, what I have into the position. Whether I'm up or down, you can see the value here. Whether I'm up or down, you can see the percentage here. what sector they fall in, whether they're a quarterly, monthly, or semi-annual payer, their current dividend yield, and look at some of these dividend yields right now, right? MPW is one. It's down significantly, and it recently cut its dividend even, and it still has an 11.76% yield. Very high yield on that. My yield on cost is only 6.33, so I'm going to continue to nibble on this one and bring my yield on cost up. Very high yielders right now. Ticker O, 6.11%. I mean, that's smoking high for Realty Income. Another one that's really high, Verizon. I'm going to continue to add to Verizon. Maybe not a lot because I'm already at 300 shares, but I'm going to continue to nibble. 1, 2, 3 shares here and there. My cost basis is 6.4%. I'd love to get that over 7%. Right, so there's a lot of high OHI, another one, 8% dividend yield, even though that one is up right now. It's still over an 8% dividend yield. Enbridge, one that's down. I'm down 16% on that. Why wouldn't I increase my cost basis? The current dividend yield is 8.28%, right? I want to increase that cost basis and get that over 7%. So I am really enjoying these pullbacks right here. I'm going to continue to add to my portfolio. Hopefully you are doing the same. Current yield, my yield on cost, the portfolio weighting. So we saw the sector weights on the previous slide. This is the weights in the individual holdings for each individual holding weight right here. Estimated annual income in this column. Payout months, what months they pay out. What their current dividend growth is over the last year. This adjusts over time. As you can see, it wasn't the 8%, it's down to 7.36%. A couple of companies have recently paid out with a little lower dividend growth rates than they currently have, so I adjust them as they adjust and where they sit within 15% of their 52-week low. So let's look at this and explain this column real quick. So I just added ticker SYY to the portfolio. So I've been waiting for it to get under, right, $73.40. So it's under that $73.40. It's currently sitting at $62.96. My cost basis is $64.20. So let's say it was above my cost basis. That's fine. I am willing to buy it all the way up to $73.40. So I will continue, even if this one was to go up above this 64.20, so long as it stays under 73.40, I'm going to continue to build this one out. Like I said, I'll probably build it out to about 100 shares, but that's the idea. Union Pacific is another one. That's another perfect example. My cost basis is $196.43. At the close of business on Friday, I got it at $199. Friday, it was $202.34. So it's over my cost basis, but I'm willing to buy it up to $211.24, right? So that is the idea behind the 15% of the 52-week low. It gives me kind of a cap of what I want to spend on a company if it's already in my portfolio. Another example, Owens Corning. I would love to build this one out, but I'm up 44.39%, and it's way over 15% at 52-week low, $83.91. It sits at 132, so it would have to come back down to under this 83.91 for me to be able to invest in this, or for me to want to add to it. Or over time, this 52-week low will raise, and if it raises up and gets to where it's under that 132, then I will add to it at that point. That's the idea behind this 15% of 52-week low column. All right, so total shares, I have 5,087.145 shares, all cumulative. Market value of my portfolio sitting at $161,728.54 currently. I have $178,204.30. If I was to sell all my positions right now, I would be down $16,475.76. Down significant amount here, which amounts to a negative return of 9.25%, down to 9.25%. But I am not selling any of these positions. I'm going to continue to hold. So really, I am not down anything. Current dividend yield sitting at 4.977%. My yield on cost, 4.517%. And this is what it's all about, in my opinion, the passive income provided by all the positions in the portfolio. Annual dividend income sitting at $8,049.06. So we passed that $8,000 mark into the $8,000 mark, on to $10,000 in annual income we go. Very nice to see this grow week over week, year over year, month over month, quarter over quarter. And the current dividend growth of the portfolio is sitting at 7.36% CAGR. So that is it. Hopefully you are doing better in your portfolio than I am. But let me know if you have some positions in your portfolio. What is the biggest gain in your portfolio? What is the position you are down the most in? Let's see, what am I down the most in? Well, it would be MPW probably right here, down 46.15%, right? My cost basis is $9.47. It's sitting at $5.10 as of the close of business on Friday. So down 46% on that one. Am still adding a little bit to it as we go along. Let me know what your biggest loser is, what your biggest gainer is. Would love to hear from you down in the comment section below. And as always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us here on this journey to financial freedom. Join the vested interest community, building a community of like-minded dividend growth investors so we can share our experiences, stocks we're watching, stocks we're avoiding, tips and tricks that we've learned along the way. We cannot benefit from each other's investing, but we can certainly benefit from each other's investing knowledge. So don't be afraid to share down in the comment section below. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. So if you have a company you'd like me to cover in the Stock Pick of the Day series, for example, go ahead and drop it down below. Or if you have any other questions about my portfolio, any positions in the portfolio, why I might have invested in them, go ahead and drop them down below as well. I do respond to the comments whenever I get some time. If I don't get to your comment, it's not that I'm avoiding you. It's that I'm super busy right now with work. So hopefully I can get to, I may not get to all the comments, but I'll get to as many as I can. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. We'll see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion. Investing in for educational and entertainment purposes. Investing involves risk and has money. Should never invest any amount not comfortable losing. Always doing own research. Invest based on your situation, circumstances, and select criteria, or seek advice counsel by a certified financial advisor.